Statistical risk tolerance and strategies. Are you ready for this?
Sure.
Let's do it. Question we have been receiving often over the past few weeks is which option strategy works best and under what conditions? For example, when to use iron condors versus strangles? Though seemingly a simple question, the answer depends on an individual trader's risk tolerance and management techniques. Nothing is theoretically better. There's definitely some optimization involved in trading.
Good and better.
So generally, just so we're clear of this, you take more risk, you get a bigger reward. You take less risk, you get a lower reward. Just remember that's how this works. We looked at the SPY for 20 years worth of data. This is a huge crapload worth of stuff we did for this to determine the risk-reward relationships of different adjustments in positions. 3 ways to adjust positions based on the risk-reward relationship are defined versus undefined, strike distance, and then we calculated the win rate, the worst P&L, the average P&L, and the average initial credit. So we're going defined versus undefined and distance away, basically to show the more risk you take, the bigger reward you get. The less risk you take, the smaller the reward.
Sure, it makes sense.
Okay, so the first thing, defined versus undefined risk. And again, this is stuff you've seen lots of times. Defined risk, iron condor, undefined risk, a strangle. Okay, same basically short strikes, just one has wings, one doesn't. You can see here on the iron condor, it's less premium and a lower pop. And the strangle is unlimited risk and a higher margin requirement. Okay, that we get that. So on the right-hand side of the page, we're looking at the back test. Let's see how it came out. The win rate, the SPY strangle, because you're taking more risk, should have a higher win rate, and it does, 70 versus 64. Your worst loss, well, your defined risk is always going to be less than your worst loss, and it does, 1,600 versus 4,000. Your CVAR, which is what happens in the worst 5% of all cases, that's still going to be worse than the strangle, but not that much worse. But here's where it flips over to the advantage strangle. Your average P&L, instead of $8, it's $26. Your standard deviation of that's the volatility of your accounts, about double, and the average initial credit is about 150% on the strangle. Okay, so all this kind of makes sense. There's nothing there that would scare you. This is not saying that a strangle is better than iron condor or an iron condor is better than strangle. This is just pointing out. You take more risk, you get bigger reward. So the next thing we did was we looked at strike distance. You want to do a 16 delta strangle, or you want to do your at the money, a straddle, essentially. Your risk level, if you go to 16 deltas, is going to be obviously lower than if you go to a straddle. And the risk, less premium, and you have a lower pop, unlimited risk, and a higher margin requirement. That's correct. When you're talking about wide strangles, the lower pop is actually wrong. So you're actually going to have a higher pop.
Higher pop, it has to.
It's going to be a higher pop.
The money.
You're going to have less premium and a higher pop. You're going to have unlimited risk and higher margin on a straddle. Okay, that's just a misprint. So when we go to backtest it, let's talk about the different things. So you take the 16 delta strangle, and surprisingly, the win rate, which this was weird to me, the win rate should be higher in the 16 delta strangle, and it's not. That's why they wrote that there, but I don't understand it. The worst loss is obviously going to be worse in the straddle. The CVAR is going to be higher in the straddle. Your average P&L is going to be almost double. Okay, the standard deviation, the volatility is going to be significantly more, and the average initial credit is obviously going to be higher. So all these numbers make sense to me, except the first one, which is the win rate.
The win rate should be the same or less, you would think, in a straddle.
That's weird.
Straddle.
Okay, but maybe that's just, who knows?
The CVR is higher.
Yeah, everything else makes sense.
You make more money.
Now we're going to define the risk. And so what happens here, when you have a $2 wide iron condor versus a $10 wide iron condor, you are going to have lower P&L and you are going to have lower premium, and it's going to be different in the wide iron condor. So when you go to the back test, you can see the wide iron condor is going to be significantly greater. And the wide iron condor is going to have 64% win rate versus 58. The worst P&L is going to be higher. It's basically straight lined all the way down. Mm-hmm. But the difference here again is that your average P&L goes from $2, which is nothing really, to $32. And that's the key. Let's go to the next slide. So by considering the risk for worst loss, a strangle is 2.5 or 2.4 times more than an iron condor, but 1.5 times less than a straddle. This is confusing. For CVAR, and again, we're going to take you through the whole thing. The strangle is 1.8 times more. For an iron condor, it's 1.7 times less than a straddle, and so on. By considering average profit, for average P&L, the strangle is 3 times more than iron condor, but 1.8 times less than a straddle. And again, I know this is confusing, so you can spend some time with it later and just take a look. This essentially just says when you take more risk, you get a bigger return. And when you take less risk, you get a smaller return. There is always a trade-off when looking at risk and reward. Setting up reasonable expectations is essential. Higher risk strategies that have a higher loss potential, but also a higher reward potential. That's correct. Traders need to learn how to adjust and pick the appropriate strategies based on their risk tolerance for a specific trade. Understanding that not every trade is the same and experience in the market goes a long way. It's really just a little bit of common sense, and it also suggests that there is potentially some optimization. Like, you don't want to do $2 wide iron condors unless you're just doing a learning event, just because the risk reward's not there. It is what it is. It's just not, it's not a big number.